Hey there, everyone. I see you out there. Russell, time is money. I'm like, oh my God, I can feel the pressure. Let me fix my screen there, right there. Okay. All right. Sorry, guys. Just had some last minute business to follow through with. I'm just adjusting my screen. Promise you, I'm not trying to give you a headache. Hope you, let me make sure everyone can hear me. One of those days, guys. This is the beauty of live, though, right? Hello. Hello. Okay, we could hear you, B. I just had to mute it for a second to make sure. Mother of mercy, we've got a lot to talk about, but I want to do this quickly. Yes, it is 4:34. Welcome to another live episode. Welcome to Be the Boss of Your Money. This is the place that you go to learn about investing, business, personal finance, and other relevant topics that will help make you the boss of your money, as opposed to your money being the boss of you. Seriously, it's very easy when your money becomes the boss of you, where we become the subject of our possessions versus the other way around. So we're going to talk about options, stock options. It's a touchy subject. I think a lot of people would like to know more about the topic. I'm going to say that 95 to 99% of the people who watch this will probably never use a stock option. You'll probably will trade it, but you may have questions about it because you hear about them all the time. What are they, and how can, this is strict educational, by the way, but how do they work? Are they dangerous? Are they extremely risky? Not just risky, but extremely risky? Or could they not be risky? The answer is all of the above on steroids. So I'm going to explain what I mean. And then we're going to do also, first, we always start with a quick market wrap and a market update. I've got screens all over the place in front of me and lots of different windows open. So we're going to roll the intro. I've got two quick intros to roll. And then we are going to get the show on the road. First, we're going to do the boring one, then we're going to do the one with the music. Da, 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 da. Okay, everybody, welcome to Be the Boss of Your Money. It is certainly a thrill to see all of you here. I hope I didn't have the mute button on. So I'm going to do my welcome one more time in case if you're just joining us right now. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. This is the place you go to learn about investing, business, personal finance, and other subjects that are pertinent to these topics, because I want you to be the boss of your money, not your money to be the boss of you. It's very easy for that to happen when your money becomes the boss of you. And we need to keep control. A very big topic these days, questions that I often receive are about options. Stock options, calls, puts. What are they? Are they extremely risky? Are they for everyone? Could they be for you? I'm going to give you the information that I believe you will need to make this decision for yourself, because I'm not here to recommend options trading to anyone. That is really comes down to a personal one-on-one conversation. But I want to give you at least an introduction to stock options so you know a little bit about them, what they are, and this way you will at least have a clue as to the next time you hear somebody talk about them or ask about them. You're curious about stock options. I get that. Calls and puts and calls, strike price, intrinsic value, time value. These are the things that you want to know a little bit about. So this is like going to be a super basic introductory. First, though, we're going to start again with the introduction. So we're not with the quick market update. So we'll do a quick share screen. And here we go. I love doing these lives. I hope you get value out of this. And if you have any questions, certainly ask me in the comments. Words of wisdom and words of appreciation. So words of wisdom and words of encouragement are always appreciated. Going over options is like a touchy subject because, like, I think 99.99% of financial advisors out there have no clue what they are. So they just give like a standard, well, oh, very dangerous, we're not going to talk about that. Or they work for a firm that really doesn't allow them to even address what they are. And I think that's a shame because it is a big topic and options could move the market. They've got some advantages, they've got some disadvantages, and we'll get into certain circumstances in which people would use options. And I think once you know a little bit about them, you'll be able to decide for yourself if they're for you or not. I'm not here to recommend options trading to you or to tell you if it's good, bad, or indifferent. It's really just a matter of, what are they? And, you can talk to me privately if you want to discuss further if they're for you or not. Okay, so now let's do the share screen. Okay. Overall, it was a pretty good day in the market, kind of the reverse of yesterday. Yesterday was a down day. Today was a big up day. Today was really a solid day. When you see all the three major averages up over 1%, the Dow up over 1%, up almost 300 points. It was up over 300 at one point today, but still a good day. S&P up 1.4%, up almost 50 points. The big move of the day is NASDAQ. So the big tech stocks, the FANG stocks, they had a really nice recovery after a sell-off. The worry for them has been rotation out of the work from home, stay at home, mega cap tech stocks into the value plays. I have to do value because everyone has a different definition of what a value play is. But I call generally the rotation from the work from home, stay at home stocks, which favors tech, versus the rest of the market, which is the reopening stocks, restaurants, cruise lines, industrial machinery, companies that are economically sensitive. So we have the NASDAQ up quite a bit. The Russell 2000 was up a little bit. That is a domestic focus. Smaller companies are more apt to get their earnings and revenues domestically as opposed to large companies who are better at getting their business from overseas. The VIX was down a lot today. This is the lowest that we've seen the VIX in ages. VIX was down 7%. That's a good thing, generally speaking, that when the markets go up, the VIX goes down. The VIX is really, it tells you that hedge funds, professional money managers, institutional investors, they are paying down to hedge their portfolios. They're paying less money or they're less interested in hedging. So the cost of hedging portfolios has gone down, and it's kind of I look at it as a form of relaxation. Yes, relaxation in the markets, less fear. Okay, that's a good way to put it. We'll just take a quick look at my watch list. All right, you see the tech stocks, the winner of the day. Healthcare was up. Utilities. That's interesting that utilities and healthcare up at this utilities and tech are up in the same day. And at the bottom of the heat, the financials were the only negative sector. Industrials were flattish. They were up yesterday. Okay. And energy was, up, not bad. Listen, energy was still up 1%. Look, overall, this was a pretty good day. I would have liked to have seen financials continue their rally from yesterday, but they rallied hard yesterday. So they calmed down a little bit. I'm fine with that. Overall, it was a good day because you had a mix of reopening stocks and tech stocks that worked out pretty good. Consumer price index, CPI, inflation numbers came out a little bit higher than expected. Believe it or not, that's a good thing. We want prices to go up a little bit. It shows that there's some economic strength, okay? What good are getting bargain basement prices for things if you don't have a job and you're afraid to spend money on anything, right? All right, so let's go on. There is a comment. I think I saw this one. Okay, thank you, Russell. Time is money. Let's go. And Tom is out there. Hey, Mitch, did you update the office with blue brick? Haha. Yes, I updated it with blue brick. You like the green screen effect back there? So I get to change my screens up every now and then, and I enjoy it. It makes it a little bit more interesting. Let me try to get my whole face on the screen, by the way. All right. I just noticed that. It just really, like, sometimes I put these shows together literally on, let me just fix at the last possible second. That made it worse. I get these shows going at the last possible second. Don't forget, I have a full-time job. I'm working. I'm taking care of clients, managing money, all the other day-to-day stuff that that goes on. So let's talk about. I'm going to stop sharing the screen for a second. We'll start sharing it again in a minute. Okay. So I want to talk to you real quick about stock options. It's not really the kind of topic that you talk about real quick unless you really have a very rudimentary introduction to it. So I'm paying attention to you. I promise. Just want to make sure I have a couple of things open today. All right. So first thing we're going to do, when talking about options, is this. Options could be very risky because options come with an expiration date. Unlike when you buy a stock, you could hold on to it for as long as you'd like. Options do come with an expiration date. That's the bad thing. So as they get close to the expiration date, they become worth less and less money. So you could buy options that to time the price of a stock move short term, a day, an hour. We could go long term, over a year. In the options world, over a year is a long time. Yes, I know long-term capital gains are a year or more, but options, a year is a pretty long time. So let's just take a quick gander at something that I want to show you, and we're going to start to pick the pace up a little bit, okay? You are required to sign a document when you buy or sell options with whatever brokerage firm you use. You have to download the characteristics and risks of standardized options. You have to, so this is the website that I'm showing you, the Options Clearing Corporation. You need to go to that website. You have to download it, or your broker could send you the document. You have to sign something that says you read this whole document and you understand it. I personally believe very few people read the document and very few people understand it, but I am pretty familiar with options. I am a options sales supervisor principal for options. Had to take a test to get that. All right, and then we're going to take a look at something else real quick. All right, and then I'm going to put this on the screen. Let me see if I can blow this up a little bit. For options, just stick with me. Be as patient as you could, okay? This is important stuff. Call options, you see the up arrow. Call options are, generally speaking, when people talk about call options, they're bullish. They could be bearish, but generally speaking, in the simplest terms of options use, call options are betting that you have a call on a stock that it's going higher. So you bet that a stock would be going higher. And a put option is bearish. You bet that a stock would be going lower. If you want to buy a stock, you think the stock is going up. If you have a pretty good feel for it, why not just buy the individual stock because you think it's going up? That is mostly what I do with my clients. If we're bullish on a stock, we commit some capital to the stock. If we are bearish on a stock, I generally prefer to just sell it. If I think a stock is going to go down, I'd rather just sell it. And if I'm worried about the market, or if I don't have a new investment that I find compelling, I'd rather sit in cash. And that's basically my strategy with my clients. But you could make a bet that a stock is going down with a put option. The nice thing about a call option is what you invest in a call option. And typically speaking, a call option is going to be roughly 8 to 12% of the cost of a stock. So I'll give you an example. If you want to buy 100 shares of Amazon, which closed at $3,100 or so today, let's call it $3,200, it's going to cost you $320,000. Okay, it's a lot. Or you could buy options that maybe cost you, a fraction of that, because a call option and a put option each control or represent 100 shares. So that's what a call option does, and a put option also. You could short a stock, bet a stock that goes down, but you could lose a lot of money, because if a stock goes up, every time a stock goes up that you're shorting, you're losing money. So if you're shorting a stock at 100, or let's say Jim Chanos, a very well-regarded short seller, hedge fund manager, said he was short selling Tesla at like $300 or $400, and Tesla went to over 1,000. If he was still short that, he's lost. Not only did he lose all of his money, but he had to keep committing more capital just to stay in the position, as opposed to buying a put. Let's say you bet $10,000 with a put that a stock could go down. The maximum you could lose is that $10,000. So the options basically they put a limit on what you could, generally speaking, lose. Okay. But I want to focus right now on call options. So a call option controls 100 shares. It's a bet. I call it a bet, not an investment, because of the time, the lack of time that you're going to have. So if you're making this bet, you could make the bet from short term to long term. The reason you'd use a call option, in my opinion, for what I would do if I was using a call option, I would use a call option short term if I'm betting on an event. If you believe a company will have a really good blowout earnings report, they're going to report next week or something, or you think a company could receive a takeover bid or something, something like that. Short term, you could buy a short term option, an option that expires very near term. Or you could use options as I know Jim Cramer from Mad Money refers to this as a stock replacement strategy. This has been going on for years, though. He may have been the first to talk about it on TV, but it's a term we all in the business use a lot. And I happen to like it, where let's say a stock is very high price, and there are so many stocks trading over 100 and over 200 and over 500, and plenty of stocks $1,000. If you want, instead of buying $1,000 stock, how many shares can you buy? 100 shares is very expensive, so you could buy an option, and maybe buy an option that expires in a year or a year and a half. Long-term equity anticipation. It's a long-term option, and you figure, well, if the stock doesn't go up in a year and a half, I'll probably have lost money in the stock anyway. So I'll just bet a smaller amount of option money. That's because that probably would have been the money I would have lost anyway. Could be. If the stock stays flat for a full year, then you lose your money in the option. If you bought the stock, at least you would have the ownership of the stock. It's just, did you want to risk like 10 times more, in some cases 20 times more money to buy the stock though? That's, to buy the same 100 shares of stock. You could always buy one share of stock versus 100 shares. Okay. One share of Amazon is a little over $3,000. But if you want to control 100 shares, you could buy an option. I was looking at the January 15th of 2022. That's when they expire. The $3,100 strike price options were like $599. So that it would be like just about $60,000 for the contract. And the reason you'd think, well, why wouldn't it be $30,000? Because you're only controlling 100. Because you said 10%. The reason is because you've got a lot of time value. So we'll talk about time value and intrinsic value. But the bottom line is, if you want to bet on a stock going up and it's a high price stock and you're willing to give it a year, year and a half, you could buy one option instead of one option instead of 100 shares, and it would just be you get to commit a lot less capital to the position. The downside is if the stock goes down a good amount, you could see your option go down percentage-wise a lot more. It could happen very quickly, and you could lose all your money in the option, but you're committing a lot less money. Certainly, you could lose all your money in a stock also. I think when you look at the high-priced stocks trading right now, by and large, I don't really believe that any of them are going to zero. Could happen, you never know, but I'm pretty confident saying stocks like Amazon and Tesla, Berkshire Hathaway. I'm pretty confident in saying that they're not going to zero in the next year, in my opinion. Okay, so that's what a call option will do. And the maximum you could lose is what you put in the call option. So instead of buying, 100 shares of Amazon for a lot of money, okay, for $3,200 times 100 is a lot, $320,000. You could go out about a year and 4 months to January of 22, and you could pick up a contract for about $60,000. And the intrinsic value on that is really about $30,000. The reason there's so much more money is because you're paying for time value. So there's two parts to. That's not the one I wanted to see. You already saw that one. Okay, so let's take intrinsic value versus time value. The intrinsic value is simply the strike price, all right, minus the stock price. And the intrinsic value is pretty small. It's like half in this case. But the strike price versus the current price is what gives you intrinsic value. This one over here, okay, you're not even seeing what I'm looking at. Okay, the green, see the green strike price. This is why I keep looking over here because I have a couple of screens open. The strike price minus the current price is, okay, of the underlying stock is the intrinsic value. Everything that you pay above that is time value. So if we could take a look at this, Amazon closed at $3,160. Let's see if this screen shows up. There's a lot on these screens, so hopefully it'll pop up in a second. If it doesn't pop up, then we're just there it goes. Okay, so if you look at these are the January 22. These expire in like a year and a half. January 15th of 2022. The strike price is $3,100. The calls are on the left. The puts are on the right. All right. The bid is the ask is $599. So let's call it $600 times 100. Okay. So it goes 2 decimal points over. So you're talking $59,900. I don't know if you can see that on your small screen. I'll try to blow it up a little bit more. But I simply put, it's about $60,000. Okay, to do this strategy. Here we go. Okay, we'll call this $599. We'll round it to $600 for argument's sake. So the strike price of $3,100 minus the cost of $3,162. It's basically an at the money option. The strike price is just about equal to the current stock of the price of $3,162. So there's really not a lot of intrinsic value. The stock would have to go a lot higher than $3,100 to get some intrinsic value going, but you're paying for like a lot of time value. Basically, it's like renting for a year and a half, 100 shares of stock. And as every day goes by, the option will be worth a little bit less. You won't notice it the first 6 to 9 months, but when you're about 6 months away from January of 2022, you're going to really start to see the value of the option go down if the price of the stock doesn't start to move up. So this has all seemed a lot simpler in my head. So I hope this helps you understand what options are and what they could do. But the bottom line is this. If a stock is very expensive, a very high price stock, doesn't mean it's overvalued. If it's, I'm just saying, stock that's like $500, $1,000 or whatever, and you want to control 100 shares, and you think that you could make money on the stock in a year, year and a half, you could buy a long-term option. If you're betting on a near-term event, the options that expire near term have very little time value. They'll be worth a lot less money. So for a nominal amount of money, you could bet on a near-term event, like a really good earnings report or something, whatever near-term event that you expect to see happen, you could bet on that. And it's the same thing with puts. Puts just simply go in reverse. You're betting the stock could go down. And if you think a stock will be a lot lower in a year, year and a half, you could buy a long-term put. If you think a company is going to have a really bad earnings report or really bad news is going to come out, then you could buy a short-term put for a nominal amount of money. Let's say you buy an option that expires in a month, and the company's earnings are coming out in a week or two. So you've got a month to see the price of the stock move down substantially. But options basically are for investors who are betting on significant moves in the price of a stock. If you think Amazon is going to be up 5%, for example, stock we've been using in a year, you probably wouldn't want to buy the option because it's not enough to cover the cost of the option. Same thing with a put. So I hope this helps you with your understanding of how to use options and why investors use options based on certain circumstances, short-term or long-term moves in the price of a stock. There are other uses of options such as hedging, something called covered calls. There's all kinds of things, and options can get pretty complicated. There's straddles, there's naked options, there's butterflies, there's all kinds of strategies, condors, that we could get into. But by and large, most investors are never going to use options in their life. And the few that do will probably just go with straight, calls or straight puts. And then a tiny fraction of that part, usually people who really understand this and professionals, will get into some pretty sophisticated options trading strategies. I personally have not met any retail investors in my 30-year plus career of doing this who have done well consistently with options. I think that these are suitable for many people. I say they are suitable for your inner gambler. If you don't have time to get to Atlantic City or Las Vegas or one of the other local casinos near you, you could certainly use options. We got a couple of comments out there. Let's see. Russell's out there. For the first time ever, I'm thinking of buying put options related to the election, either mid-November or December. But I agree, timing is the hard part. Yes, buddy, timing certainly is certainly the hard part. So, you might want to maybe give yourself look. It's a known event. The election is November 3rd, I think it is, right? You know the exact date of the election, so it's not that hard to pick which time horizon of expiration you want to use in the option. So that's okay. If that's something you want to do, you're happy to be in the money management business. You're a professional, so go for it. And I have nothing against anybody who uses options. Options are a very big market. Okay. And Madoff used a put call strategy. Yes, Madoff used a put call strike strategy or something like that. We all know how that worked, right? Jeff is at. Thank you, Jeff. Nice job out there on LinkedIn. Thank you very much. I do my best to explain this stuff, but my mind is working faster than my mouth could go, and it just comes out garbled sometimes, And Russ is out there. Agreed, options trading is not the norm for retail investors. Absolutely, the norm for most retail investors is you buy mutual funds or ETFs, index funds, or not. You don't have to buy index funds. I mean, I use them for my clients. I don't have anything against them. I know a lot of financial advisors knock index funds because they look at it as like, oh, that's competition. What if my clients just go to Vanguard or BlackRock and don't use me? That's not what investing is all about, and it's not what financial planning is all about. Come on, pipe down, show a little backbone. There's a lot more to investing than just buying an index fund. Okay, so but I use them as a tool. They're just tools. I use them as tools. I have a big toolbox as a professional. Okay, so that's my story. I'm sticking to it. Thanks everyone for watching. Russell, I would love to hear more about your option strategy if you decide to go ahead with that for the election. I'm thinking you're probably going to be bearish, but you really have to look at how the market does before the election. If the market plunges before the election, maybe you're going to want to go with a call. Okay, we'll see. We also have to see how the reopening goes. I mean, can you imagine the next term, whoever's president could see a real resurgence in the economy and a real a strong rebound in the economy. Well done, Russell. I'm going to put that up on the screen. Thank you. Well done. Thank you very much. Yes, for protection, hedging. All right, I'm going to get going. It's still a nice day out. Hope everyone who lives near me got your power back, and I'll be here tomorrow with a really cool guest. Okay. Yes. I'll give you a shot. I love talking to you. Tomorrow I have a really cool guest. His name is Joey Gelfand in the creative sector, very content creation kind of business. And I'm looking forward to having him on the show. All right. See you tomorrow. Thank you. Thank you very much.